In this video, I'm going to show you 10 popular Australian ETFs in 10 minutes. Let's get straight into it. The first ETF is VAS, which is the Vanguard Australian Shares Index ETF. This ETF tracks the top 300 companies listed on the ASX, including blue chip companies like Commonwealth, BHP, Telstra, and Woolworths. And just like all the other ETFs on this list, you can find all their full details on their website. This is arguably the most popular ETF listed on the ASX, and it's in fact the largest in size with approximately 11 billion assets under management. They are run by Vanguard, which is one of the largest and most reputable investment companies in the world, with $11.3 trillion in total assets under management globally. Alright, let's check out their stats. Their management fee is 0.1% per year, which is quite cheap. For context, if you invested $1,000, then you would only pay $1 of management fee. And if you invested $10,000, then you would only pay $10 management fee, and so on and so forth. This fee is automatically deducted from the fund and is reflected in the share price, so you don't have to worry about having to pay it directly yourself. And the same applies for every ETF mentioned in this video. The 3-year return is 8.17%. This is what the fund has returned on average per year for the last 3 years. The 5-year return is 9.08%. Again, this is the average return per year for the last 5 years. ETFs don't always go in a straight line, so this is just the average cost per year. This is a way to show you how the ETF has historically performed, but please remember, past performances don't equal future results. This is in line with the historical average that the Australian stock market has returned in the last 30 years. The dividend yield is currently 4.1%. This is calculated by dividing the dividend per share by the market price per share and multiplying it by 100. I just want to point out that the dividend yield can sometimes be misleading because 4% yield may look good, but the yield may be higher because the share price of VAS has gone down in the last year. Now, this might not always be the case, but it's something for you to keep in mind that just because the stock has a high yield doesn't necessarily mean it's a good thing. A lot of new investors get sucked into stocks because of their high dividend yield, but that may not always be a good thing. If you're picking a stock for its dividend yield, then always do further research on why it's high and if it's sustainable. The dividends for this ETF is paid quarterly, which means you'll be paid dividends 4 times a year. If you want to check out the exact dates you'll be paid or the dividends history, you can check it out on their website under distribution history. This ETF is domiciled in Australia, which means the ETF was formed, registered and regulated in Australia, is resident in Australia for tax purposes, and whose home exchange is the ASX. This also means you can set your dividends to auto reinvest, which enables you to compound your returns over time by accumulating more shares, which themselves will pay dividends to be reinvested. This ETF includes franking credits for a portion of its dividends. A franking credit is a tax credit paid by companies to their shareholders along with their dividend payments. This is a way to help you avoid a double tax since they have already paid the tax on your behalf. This tax credit is unique to Australia, and depending on your tax bracket, you may be able to reduce the tax you pay by receiving a credit during your tax return. The second ETF is A200 by Beta Shares. This ETF is very similar to VAS, but instead of tracking the top 300 companies in Australia, it tracks the top 200 companies instead. This means there are less small cap companies in this ETF, and it is comprised of mainly large and medium cap companies in Australia. As you can see, the top 10 holdings are very similar to VAS, given they track a similar index. The weighting for the top companies may be slightly higher since there is 100 less companies in the ETF. Now let's check out their stats. Management fee is 0.07%, which is slightly cheaper than VAS. The 3-year average return is 8.15%. This is very similar to VAS as you would expect, given the majority of the fund has the same companies. The 5-year average return does not exist for this company because the fund only started back in May 2018 and it's only been 4 years. The dividend yield is 3.5%, and just like VAS, the dividends are paid quarterly. And the ETF is domiciled in Australia, meaning the dividends can be set to auto reinvest. And again, like VAS, this ETF includes franking credits for a portion of its dividends. So overall, this ETF is very similar to VAS, and in the long run, their performance should be very similar. By the way, just a full disclaimer, I am not a financial advisor and these are not buy recommendations. This is just a list of 10 popular ETFs that I put together. The comments I make today are for educational purposes only, so please use the information as a guide only to do your own research. Also, a small reminder that just because an ETF is considered safer than individual stocks, this does not mean it's risk-free. Just like any other asset class, ETFs are also vulnerable to market conditions, so please keep this in mind. Now let's get back to it. The third ETF is VTS, which is the Vanguard US Total Market Shares Index. This ETF tracks the return of the entire US market index, including well-known companies like Apple, Amazon, Berkshire Hathaway, and Meta Platforms, previously known as Facebook. If you are buying this ETF, then it means you are bullish on the US stock market to do well over the long term. When you hear people speak about the market, so for example, you might see on the news that the market has gone up or down, unless they specify which market, they are usually referring to the US market. This is because the US stock market makes up about 60% of the entire global market, and you can get a slice of it by investing in this ETF. Alright, let's check out their stats. Management fee is 0.03%. This is one of the cheapest management fees on this list. The 3-year average return is 14.14%. The 5-year average return is 13.55%. These high returns are due to the US market being in a massive bull run over the last decade, and in particular the last 2 years. The dividend yield is 1.4%. and like most Vanguard ETFs, dividends are paid quarterly. And unlike the other ETFs on this list, it is domiciled in the United States. This means that unfortunately, you cannot auto-reinvest your dividends, and you'll be required to fill out a W-8 BEN form, which is a document that ensures you are not double taxed to the US when filing your taxes. But don't worry, it's very easy to fill out, and some online brokers even do it automatically for you. So it's no big deal. And since there are no Aussie stocks on this ETF, there is no franking credits. The fourth ETF is IVV, which is the iShares ETF that tracks the performance of the S&P 500 index. The S&P 500 is probably the most famous index fund in the world, which tracks the top 500 US companies, including Apple, Tesla, Visa, and Coca-Cola. When you hear people talking about index funds, they are usually referring to the S&P 500, which is basically a barometer on how well the economy is doing. So if you compare it to VTS, this ETF tracks the top 500 companies instead of tracking the entire US market. Alright, let's look at the stats. The management fee is 0.04%, which is very cheap, similar to VTS. The 3-year average return is 11.05%. The 5-year average return is 13.47%. Again, they are very similar to VTS. The dividend yield is 1.28% and dividends are paid quarterly. And unlike VTS, it's actually domiciled in Australia. So even though it tracks the US market, you don't need to fill out any forms since the ETF is based in Australia, and you can choose to automatically reinvest the dividends like all the other ETFs on this list. And since there are no Aussie stocks, there are no franking credits for this ETF. The fifth ETF on this list is VGS, which is another Vanguard ETF which tracks the return of the global world market index excluding Australia. This ETF provides exposure to some of the largest companies in the world, including Apple, Amazon, Johnson & Johnson, and Sony. In fact, there are over 1,400 companies in this fund, so it is very well diversified. The fund is made up of 70% US stocks, and the remainder is made up of other major developed countries like Japan, UK, Canada, and France. Alright, give me the stats. The management fee is 0.18%. The 3-year average return is 11.7%. The 5-year average return is 10.85%. Again, this is not surprising given the strength of the US market in the last decade. The dividend yield is 1.9% and dividends are paid quarterly as you would expect. Even though the ETF does not include Australian stocks, it is still domiciled in Australia, so you can receive the benefits of auto-reinvesting your dividends. And they don't have franking credits since this ETF tracks the entire global market excluding Australia. The 6th ETF is IOO, which is the iShares Global 100 ETF that tracks the top 100 global companies in the world. It is similar to VGS in that it tracks the top blue chip companies in the world. The only difference is it includes Australian companies and it only tracks the top 100 global companies instead of over 1,400 like VGS. So it is a much more exclusive ETF. So in a way, it's less diversified but more focused on the cream of the crop companies. The top holdings include international blue chip companies like Apple, JP Morgan, Samsung, Toyota, and BHP. Now let's break down the stats. The management fee is 0.4%, the 3-year average return is 11.87%, the 5-year average return is 13.18%, and interestingly, it performed a bit better than VGS, probably because there is a slightly higher weighting in US stocks. The dividend yield is 1.6% and dividends are paid semi-annually, so you only get paid twice a year. This ETF is domiciled in Australia, which means you can set the dividends to auto-reinvest as usual, and even though it contains a small portion of Aussie stocks, it's too insignificant to have any franking credits. The 7th ETF on this list is ETHI, which is the BetaShares Global Sustainability Leaders ETF. As the name suggests, this ETF tracks the top 200 leading ethical companies in the world. With the world moving towards a more sustainable future, the trend towards responsible investing has grown rapidly. There are studies that show that ethical investing is particularly popular amongst millennials and the new generation of investors coming through. Some of the top companies include Visa, Home Depot, Apple, and Nvidia. In order to make it into the portfolio, each company is carefully screened and have to pass their strict criteria of being a market leader and no direct or significant exposure to fossil fuels or other activities deemed to go against responsible investing. Alright, let's check out their stats. Management fee is 0.49%, so it is a bit more pricier than the other ETFs on this list due to the more work with the selection process. The 3-year average return is 17.55%, the 5-year average return is 15.98%, so they have performed incredibly well in the last few years due to the popularity in ethical investing. Please keep in mind that the fund was created in January 2017, so it is still a new fund, so we'll have to see how it performs in the longer term. The dividend yield is 6.1%, and this yield is quite high due to the share price going down in the last year. Dividends are paid semi-annually, so twice a year, and they are domiciled in Australia, and you already know what that means. And there is no franking credits involved. The 8th ETF is NDQ, which is the BetaShares Nasdaq 100 ETF. This ETF tracks the top 100 non-financial companies listed on the Nasdaq index. This index is famous for being very tech heavy, so it mainly comprises of all the biggest tech companies in the world. So companies like Apple, Microsoft, Google, Amazon, Meta Platforms, and Tesla. However, it's not all tech. There are other non-financial companies like PepsiCo, Costco, and Starbucks. If you check out their stats, their management fee is 0.38%, so it is a bit pricier compared to other similar ETFs like IVV and VTS. The 3-year average return is 19.94%, and the 5-year average return is 18.15%. These incredible returns is mainly due to the tech boom that has seen extraordinary gains to large tech companies in the last decade, along with one of the longest bull markets in history. The dividend yield is 4.2%, and they are domiciled in Australia, so you can auto-reinvest your dividends. And since it's only US stocks, there are no franking credits involved. The 9th ETF on this list is VDHG, which is the Vanguard Diversified High Growth Index ETF. This ETF is a one-stop shop if you want maximum diversification. That is because it tracks the average return of pretty much the entire global market. It is made up of several Vanguard ETFs, so it's basically an ETF of Vanguard ETFs. Here is a list of their asset allocation, which includes a portion of Australian shares, international shares from developed countries, so countries like the US, UK, and Canada, and international shares from emerging markets, so countries like China, South Korea, and Taiwan. It also includes some bond and fixed interest index, so a bit of a defensive allocation. Let's check out the stats. The management fee is 0.27%, the 3-year average return is 8.83%, the 5-year average return is 9.03%, so as you would expect, it's pretty much in line with the entire global market. The dividend yield is 2%, dividends are paid quarterly, it is domiciled in Australia. Since it contains some Australian shares, a portion of the dividends is partially franked, so make sure you include these credits during tax time. The 10th and final ETF is DHHF, which is the Beta Shares Diversified All Growth ETF. This ETF is somewhat similar to VDHG and is allocated into 4 portions: Australian shares, US shares, other developed countries not including US, and emerging markets like China, Taiwan, and South Korea. This ETF is a bit more aggressive than VDHG as it does not include bonds and fixed interest. It's solely focused on growth. If we look at the stats here, the management fee is 0.19%, so it is a bit cheaper than VDHG. It does not have a 3 and 5-year average return, given the fund was only created in December 2019, but it has averaged about 8% per year since inception. The dividend yield is 3%, and dividends are paid quarterly, and they are domiciled in Australia. And since there is a significant portion of Australian shares, it will be partially franked. And there you have it, friends. That was 10 dividends in 10 minutes. If you enjoyed this video, then please give it a like and make sure you subscribe to my channel because I make a ton of personal finance videos like this and you don't want to miss them. If you would like to see more content, then check out these videos on screen. And until next time, my name is Brian and I hope you make a lot of money.